Hi, my name is Ahmed, and I'm the operations manager at FleetSpark. At FleetSpark, we help you navigate the complexities of the trucking business. This is video 7 in our Trucking 101 series. In the previous video, we gave you a step-by-step guide to getting your MC authority and active status. In this video, we'll cover why new authority trucking insurance is so difficult to get, what insurers are really pricing, and how to plan so insurance doesn't stop you from being operational. Even after you get coverage in place, insurers typically treat your first 12 to 24 months as new authority. That's the period where you're building a track record they can actually price, based on how you operate and how clean your history stays. During that period, insurers price you for uncertainty, which means premiums are higher and approvals can be slower or even denied. For most new owner-operators, insurance becomes the biggest early fixed cost, and often the main barrier between having a truck on paper and being able to operate in real life. Insurance is the gatekeeper in trucking. If you can't secure the right coverage, you can't operate, period. And in practical terms, insurers set the real operating boundaries because they decide who gets covered, on what terms, and at what cost. Insurance companies act like three gatekeepers at once. Financially, they want to see you can afford the risk. Operationally, they expect your setup and paperwork to stay compliant. And on safety, they price and enforce standards based on your driving history and claims exposure. Another key rule is that your insurance has to match your real operation. That means the policy details must line up with your cargo, your equipment, and your operating radius. It also needs to match the driver on the truck, your authority filings, and your operation type. That's where many new owner-operators get tempted to round down the details to chase a lower premium. But if the policy doesn't match your actual operation, it can fall apart when you file a claim. Insurance premiums are usually driven by the same core factors: verifiable experience in similar equipment and lanes, your driving record, and your operating radius. Where the truck is garaged, the type and value of the equipment, the cargo you haul, and how consistent your information is across every document. Your business identity and operating description need to match across every document. When the details don't line up, underwriters read it as disorder, and that usually leads to a denial or a much higher premium. Insurance affects a new owner-operator's economics in a few direct ways. It's a fixed monthly bill you owe even when the truck isn't moving. It often comes with an upfront down payment before you've earned your first dollar. And it compounds equipment payments, because a tight truck note plus high insurance plus a few slow weeks is one of the fastest ways new carriers run out of cash. A survivable new authority plan is one where you can absorb a slow first month and a deductible, and a repair week, and still stay current on insurance and your truck payment. If you operate cleanly for your first 12 to 24 months, premiums often become more manageable. A consistent safety record and a steady operating profile make you easier to underwrite, and you usually have more options when it's time to renew. To recap, new authority trucking insurance is expensive and sometimes hard to secure because your carrier is still unproven and insurers price the risk of the unknown. Match your real operations and plan for these fixed costs. If you're ready to move forward, reach out to our team at FleetSparkFinancial.com. We'll review your plan and map out the clean next steps, so you're not guessing your way into a policy that doesn't fit your operation.